The 60-40 portfolio is usually referring to an allocation of 60% equities and 40% bonds. This kind of portfolio is usually the default answer for most advisors, or if you look for investment advice on how you should allocate your assets. The reason for this portfolio is bonds should give you some downside protection in case the market drops, and you still get some yield from the fixed income term. Let's say if you buy treasury notes, they would pay you every year some fixed income that will boost your portfolio, and you get obviously your returns from equity. But in this video I want to outline why this portfolio is dead and what could potentially replace it. If we look at the interest rates in the United States, this will give us the key answer on why this portfolio is not working in the future. So we can see on this chart is a long-term chart, so you can see it starting in the 60s. And since the 1980s, interest rates were dropping. So you can see this channel down, basically landing at zero now after the COVID-19 epidemic. The Federal Reserve dropped the interest rates, and we can see here the 10-year yield close to zero. So basically now, if you would give the US government your money, after 10 years you get less than 1% back. So that's not really a good deal for individual investors. Obviously, bonds have their part of a portfolio, and still they balance a portfolio due to the negative correlation to equities. But the yield we're getting is just low. So if we now look again at the yield, and here on the chart as well I included a total bond market index. So you can see here you got decent returns actually over the years, and this is due to the correlation that if yields are dropping, the price of a bond will increase. So that's what helped actually investors to get good returns from bond funds. If we now do a back test of 10 years, we can see even with the big drop, on an annual basis, the S&P 500 returned for the last 10 years roughly 16%. The balanced portfolio 60-40 around 10%, and the bond fund alone roughly 4.5%. So we can see here as well on the chart that the balanced portfolio is doing what it's supposed to do. During downturns, it helps to smoothen out the curve and the downturn. Obviously as well, your return is not as good, but you can see it's plotting along, and it's a nice uptrend due to the mix of bonds and equity and the negative correlation. So if we look at the same thing, just a 1 year backtrack, of course we can see the big drop due to COVID-19 here, but you can see how interest rates dramatically fall. And this will have an impact, of course, on our long-term performance. So you can see in the last 1 year, this bond index, it gained 9%. But the problem is now, what will happen going forward? So in the next few slides, I want to outline a few ideas on how we can tackle this issue. Of course, I don't have a crystal ball, and I don't know how markets will behave in the next decade, but I want to give you an idea of things that can be implemented and that might help you. So option number one, obviously increase more risk. So if you're a retiree, or if you need to withdraw money from your portfolio, if the 40% in equity is not giving you enough return to achieve your withdrawal rate, you need to get more risk, right? So what could happen is that you change from a 60-40 to 80-20 to achieve your same performance. This is rather obvious, but obviously it decreases a lot your downside risk. The next option is to use leverage. Due to the low yields that you're now getting, an advantage on the other side is that you can borrow money relatively cheaply. So you could use your margin loans, or you could use funds that use leverage to increase your exposure. What I mean by that is you could, for example, have a 1.5 leverage, and you then use, let's say, a 90% equity, 60% bonds, and you still have the same kind of 40-60% ratio, but you use the leverage to get more returns. This could be another option on how you meet your needs as an investor. The next option that came to my mind is that you kind of spike the bond allocation. As we know, the 40% is not giving us the return we need. We need to find a way to increase our return. Obviously, as well, it includes taking on more risk, but it might help us to achieve what we need. Emerging market bonds still pay much more yield than what we get in developed markets. So this could be one option to increase our portfolio. The other options could be to use REITs or utility companies, ETFs, that pay a very solid dividend and are a bit more safer than, let's say, technology stocks. This might be a good way as well to take some of our allocation from the bond out and allocate them to something else that is a bit more, let's say, safer compared to equity, but gives us more returns. So you could say that you're taking maybe 10 or 20% out of your bond allocation and put them towards those kind of investments. You could also use any kind of low volatility strategy with this as well. And the last option would be a combination. So for example, we could keep our 60% equity, but then say we use a leveraged treasury ETF that is giving us the downside protection and the negative correlation to stocks. And then we want to get some extra returns by adding in REITs, for example, or EM debt or utilities to get a bit more return to our portfolio what we need. This could be like a mixed approach that might also work.